On behalf of Caesarstone, I'm pleased to welcome you to the first education session this morning. The first education is on construction industry and Texas taxes, sales, franchise, motor fuels, and audit issues. We have, it's going to be presented by Jimmy Martens, partner with Martens, Todd, Leonard, and Ahlrich. In this session, Jimmy will discuss the current issues involving the franchise tax, sales tax, and motor fuels tax for the construction industry, and will help you identify potential issues and opportunities for construction industry companies under the Texas tax laws. Please join me in welcoming Jimmy.
Thank you, everyone. And I appreciate you being here. Can everybody hear me okay? Can you hear me now? Okay, sorry. I'm trying to get over the volume of the crowd. Well, thank you for being here at 11 o'clock in the morning to listen to taxes. As I hear those words come out of my mouth, it sounds almost like punishment. Thank you for bearing with me. I'm a trial lawyer. And my law partners, we have a specialized firm in Austin, Texas, and we spend our days fighting with the comptroller's office, Texas comptroller's office, on behalf of our clients, most of whom are either oil field service companies or construction companies, fighting audit assessments. So they asked me to speak here today because we have knowledge of the issues in the three taxes I'm going to talk about. I want to start first to talk about the franchise tax. The franchise tax, if you owe this tax, it's important that you file the forms. And the reason for it is, if you don't file the forms, you can become personally liable for all the debts of your business. Those that arise during the period of time that the forms are not filed but should have been filed, okay? And so that could be contract debts if somebody gets hurt and they sue you. It could be tort debts, all kinds of debts. So you want to make sure the forms are filed. The tax is not really that much. It's a fairly low rate. But the tax, for purposes of this discussion, and I'm limiting my discussion to the businesses that basically residential contractors, our corporations, LLCs, general partnerships, limited liability partnerships, and the so-called LLPs, not sole proprietorship. So if you are a sole proprietorship, you don't have to worry about this tax. Everybody else does. This tax is calculated 5 ways, okay? And there are 5 fairly simple calculations. You really, for your purposes, only have to deal with the first one and the last one, okay? So we'll start with the first one. The very first number, revenue, is the same for all of these calculations. And it's made up of 2 numbers. It's your federal revenues. So if you're a home builder, you take in revenues from building homes, selling homes. That's your starting point, your federal revenues. And from that, you subtract your subcontractor payments. And the difference between those two is revenue. Now, for purposes of this calculation, you subtract cost of goods sold. And you may be thinking, well, wait a minute, I'm a home builder, I don't sell goods. How could I deduct a cost of goods sold? Well, the statute allows real estate contractors and subcontractors to claim a cost of goods sold deduction. You get to claim one because the statute says you do. Even though you don't really sell goods, they allow it. And your cost of goods sold deduction is your materials and your labor and your supplies and your depreciation, and you get 4% of your overhead. Anyway, the difference between those two is your tax base. Now, if for some reason you're building homes out of state, generating revenues out of state, you would only tax the percent of your business that's in Texas. So if half of your revenues are in Louisiana and half of your revenues are in Texas, you would only tax half of your tax base, your tax margin in Texas. And then for our purposes, our tax rate is 0.0075, 0.75%. Now, the next calculation is exactly the same, except we only are deducting labor. So it's not really relevant for us because we want to deduct materials. The next calculation is exactly the same, except we have a deduction that's equal to 30% of revenues. So if our revenue's $10 million, the deduction's $3 million. It's just math. The next one is a flat $1 million deduction. And then the final one that could be relevant is this deduction called EZ. And it applies when that revenue number, that is your federal revenues minus your subcontractor payments, when they are less than $20 million, you can claim this method. You don't get any deductions at all, but you pay tax at a very low rate. It's like 1/3%, okay? And so these are our 5 methods. If you calculate the tax and no tax is due, you have a no tax due report. If the no tax due report needs to be filed, you must file it. And the reason for that is when the Texas laws require that you file a report and you don't file it, that makes the officers and directors and the managing members and the owners and the limited partners of the businesses liable for debts of the business. And the reason you create these entities, your lawyers create these entities, is because you don't want to have personal liability. And it all gets erased if you don't file these forms, so you want to file the forms. And these are just pictures of the different kind of forms that you might file. And you file along with these forms public information forms that tells the public who the officers and directors and owners of the businesses are. Okay, so people will know who they can sue from other forms you may have filed if you're not filing these forms or filing them on time. So, just by way of example, the calculation starts out, you would take for example, your federal tax return, add up the items of income, not deductions, but income off of that form. You would subtract your subcontractor payments. Now, this is funny language the statute gives us. They talk about money that, say, comes to a general contractor that's paid out to a subcontractor to provide labor, materials, and services in connection with these activities. These are real estate construction type activities. So if these are your circumstances, like most subcontractor payments would be, you get the subtraction. We tried a case for Titan Industries to test how far you could take subcontractor payments. And the court ruled that our client, Titan Industries, could claim a deduction for the payments it made to independent haulers for aggregate. So Titan Transportation would get a call from a contractor at a construction site for 10 loads of road base. They'd go to a quarry, or they would call the independent haulers who would go to the quarry, pick up the loads of road base, take them out to the construction site and dump them, to be used for the foundation or for the parking lots or whatever. And Titan sought to remove from its revenues its payments to the independent haulers. The comptroller said no, but the court turned around and said yes. The comptroller said no, they're not a contractor, they're a transportation company. But the court said no, the statute is broad enough to pick up businesses that are removed, one step removed from the construction process. So the point of this discussion is to know that this subtraction from your revenue is broad enough to pick up not just real estate contractors and subcontractors, but those businesses that are service related to you. You also get a deduction for not just your subcontractor payments, but for your internal cost. And here I'm talking about your materials, the cost of your materials, the cost of your labor, cost of your supervisors, the depreciation of your equipment, all of those costs that go into what you pay for to render your performance under a contract, that is to build homes. We tried a case for New Park Resources to test how far this statute went. Well, I know New Park wasn't a home builder. They were drilling an oil well offshore, but it's the exact same principle. The construction of an oil well is no different than the building of a home under the law. New Park Resources was, all they were doing was hauling debris away from a well site. And the court held that they qualified as a real estate contractor and were entitled to include their cost, their barge cost, their fuel cost, the operations cost, their landfill cost, as a cost of goods sold, even though they weren't selling anything, could include them in their deduction. And so out of this, we see, for our purposes, this calculation. We start with our federal revenues from our tax return, minus our subcontractor payments, minus our internal cost that are out at the site, so to speak, and then we get a deduction for 4% of our overhead. That gives us our, what we call our tax base, margin, or kind of like our gross profits, times 0.75% gives us our tax. And that's pretty much our calculation. And really, all you need to know about franchise tax for your purposes. The most critical thing is, don't forget to file the forms because you don't want that personal liability. Let me turn to the sales tax now, because that's really where most of the issues with us lie. So, Texas imposes the sales tax on the sale of tangible personal property, that is, like things that are movable, chairs, the lumber that you would buy, the consumables that you would purchase in connection with building a home, like plastic sheeting, sandblasting materials. We impose it on equipment. We impose it on equipment that we lease. If the outright purchase of a piece of equipment would be subject to sales tax, then we impose the sales tax on equipment that we lease. Now note, Texas has a use tax, which is a parallel law to a sales tax. The sales tax applies when you buy something in Texas from a Texas company. A lot of home builders are buying things from out of state, where the out of state company is not charging tax on the things that you're buying. And they don't have to. They only have to charge tax if they have a physical presence in Texas, if they've got an office here, or if they've got salespeople here, or if they're delivering using their own trucks. That's the only time an out-of-state company has to collect taxes here. But just because they don't have to collect those taxes doesn't mean that you don't owe them. You don't owe them as a sales tax, but you owe them as a use tax. So if you're building a home under what will be we'll talk about this, a lump sum contract, where you're going to owe tax on those materials, and you're buying these materials out of state, and your out of state supplier is not charging you sales tax, and they don't have to because they don't have a connection with Texas, and they ship them in by common carrier to your site, you have to pay use tax at the same rate of sales tax on that purchase. And there is a form that the comptroller has to report that. And the reason I'm telling you about that is if you get audited, the auditors are going to look at your books, and the auditors are going to test the purchases that you've made. And they know these big suppliers that are out of state that are not collecting tax. And if they see their names, they're going to know that they're going to know to go look to see if you have filed these forms. They call them use tax forms, to see if you've paid that use tax on these materials. So it's materials you might buy out of state, equipment you might buy out of state, computers you buy out of state, software, anything you buy out of state, you want to make sure you're paying tax on them. Okay, now, with respect to construction sites materials, you don't owe tax on water, you don't owe tax on cement, and you don't owe tax on unprocessed materials. So if you buy a load of sand or a load of gravel or dirt, things that are just dug up out of the earth and sold to you in that form in which they're dug up, like flagstone, just picked up out of the earth, not cut, not mixed, not processed, that is not a taxable item in Texas. But if you go to a quarry and if you buy, say, rock that's been cut or rock that's been blasted out of the side of the quarry, that's considered processed material, and that is subject to tax. So you want to be mindful at that point of materials. Now, continuing on through the construction process, here we're talking about a neighborhood, and we're talking about the development of a neighborhood. So when we come to an area of land and we're developing a neighborhood, we'll often initially install temporary erosion control measures. So we may install silt fencing, we may have temporary inlet protections, we may put things down like retention blankets and so forth. Temporary erosion control measures are treated as fully taxable by the comptroller's office and the courts. They treat them as the sale and installation of tangible personal property. We contrast that with permanent erosion control measures. So if we are installing items like this, or retention ponds, we're digging retention ponds, or berms, we're digging berms, or retaining walls, underground sprinkling systems, French drains, fencing, anything that is of a permanent nature is considered a real property improvement. And we'll see in just a moment, when you're engaged in residential construction, that is, you are improving real property for residential purposes, the labor charge is not subject to tax. Now let me make a distinction between residential and commercial. In Texas, we have two types of structures: residential and commercial. Commercial means non-residential. I wish they said residential and non-residential, but they don't. It's residential and commercial. Residential structures are places where people normally live 30 days or more consecutively. So they're homes, duplexes, apartments, fourplexes, okay? This hotel is not a residential structure because people don't typically stay in hotels 30 consecutive days. They're here for a few days, maybe a week, and then they're gone. Okay, so the rules that we're discussing would not apply to this hotel. So when we're talking about the construction of residential structures, the labor charge is never subject to tax. And that applies to whether it's new construction or whether it's repairs and remodeling. What is subject to tax is the materials. Okay, now here I'm talking about taxable jobs, building homes. I'm not talking about tax exempt jobs like the roads and so forth. So materials are always taxable. The question is not whether materials are taxable, but who owes the tax on the materials? And we answer that question by asking, what type of contract is it? In Texas, we have two forms of contracts. We have what's called a separated contract, and we have what's called a lump sum contract. In the case of a separated contract, the customer owes the sales tax. And I like a separated contract we'll see as a contract where the entire charge for the materials is separate from everything else. And when you operate under a separated contract, we also think of these as time and material contracts. When you are performing your work under a separated contract, the law pretends that you are selling the materials and the labor separately. Okay? Let me give you an example where it could be really meaningful. Say I have plans for a new home that I want built. And I go to a home builder and I say, here are my plans. I want you to look at this and give me a bid for what you think it's going to cost to build my home. And the contractor comes back and says, okay, it's going to cost $1,040,000. That's my bid. And I said, okay, and it's just a lump sum number. And I say, okay, how did you get that number? And the contractor says, well, $500,000 in labor, $500,000 in materials, and then I'm going to have to pay tax of $40,000 on those materials. So that's $1,040,000. If I'm thinking about taxes, and here I'm thinking about my federal taxes, and in particular my itemized deductions, I might say to that home builder, look, I'm okay with your price, but I want you to make this a separated contract. By law, I don't want you to sell me a home. That's real property. That's not subject to sales tax. What I want you to do is sell me your labor and sell me your materials, and when the contractor performs his work under that separated contract, he's not selling me a home. I know when he's done, I have a home, but by law, he is selling me labor and materials. I'm treated as having purchased the materials and having paid tax on those materials. And that means when I sit down on April 14th to fill out my federal income tax return, and I go to my Schedule A, that itemized deduction form where you can take itemized deductions for your interest and your charitable contributions. Well, there's a deduction for the sales tax that you pay on large purchases. I could take a deduction for that $40,000 in sales tax, okay? So when you're talking to your customers or clients, you may want to think about, is it a selling point for them to say, let me do this as a separated contract and you can get a big deduction on your federal income tax return, because if you buy my labor and my materials rather than buying a home for me under a lump sum contract, you can deduct the sales taxes. Yes, ma'am. Oh, ma'am, I can't hear you. There's so much noise back there. Come to me afterwards and I'll talk to you. In a lump sum contract, the contractor is selling real estate. Real estate is not subject to sales tax. That means that the contractor is the consumer, the end user of the materials, and therefore owes the sales tax. So, when do we have a separated contract? First, we have a separated contract when the entire material charge is separate from everything else. And here, we've got to be very careful. Say I am a fencing contractor. People come to me to install fences, okay, around their, either a home builder comes to me or an owner comes to me to install fences around their yard. And I've got a fabrication shop and I buy raw steel from a vendor and I cut it up and I weld it into prefabricated 8-foot sections of fencing material. And when I get a job, I get what I need out of my inventory and I go out to the site and I dig my post holes and I install the fence by concreting it into the land. And having done so, I have improved the real estate and I am a contractor. And I send them a bill, and my bill states fencing panels, $10,000, installation labor, $5,000. That is a lump sum contract. That is not a separated contract. The reason that is a lump sum contract is because I have not separately stated the entire material charge. I have fabrication labor that is buried in the price of those panels that I built back in my fabrication shop. So be careful. It's real important, because if you think you're operating under a lump sum contract, but you're really operating under a separated contract, or vice versa, you're going to be collecting tax when you should be paying tax, or you're going to be paying tax when you should be collecting it. And when you get audited, the auditors are going to make you pay one way and may not give you credit back the other way for it. And of course, if you've ever been in this position, it's really hard to go back to somebody 4 years later and get them to pay back taxes on things you might have missed early on. Right, and it's a good point. If you think you are a lump sum contractor, you're paying tax on the cost of your materials. But if it turns out you're really operating under a separated contract, not only did you pay tax in error to your supplier, you should have given them a resale certificate. The comptroller will force you to pay audit tax on what you should have collected from your customer, which would be the marked up price of your materials. And so some auditors will give you credit for the tax you paid on the cost, but you're going to be out the difference of the tax on the markup. Next, cost plus contracts are always viewed as separated contracts for the reason that the owner can always go back in and audit your records and make that distinction. And then finally, oftentimes contracts will state a lump sum price, but they will incorporate schedules of value. You may have a project foreman who's got an Excel spreadsheet who is tracking materials and labor by phase of what's going on. If the contract incorporates by reference a schedule of values, they are used for your progress payments and so forth. If that's what's happening and that schedule is incorporated into the contract, the comptroller will transform what you think is a lump sum contract, because it's stating a lump sum price, into a separated contract, meaning they're going to assess you tax on your price for the material charge, what they would say is the material charge as reflected in those schedules of value, and may or may not give you credit for the tax you paid in error back to your vendor on the items that you purchased. And I thank you for your comments, and I have to apologize. I've got so much noise coming at me, it's really hard for me to hear, but I'm glad to talk to anybody afterwards. Or you can stand right there and scream at me. I'll take it either way. Ma'am, and I'm really, really sorry. There is so much noise on that side back there, I cannot hear what you're saying. If you want to come up here. Yes. Yeah, the question is, in the case of a separated contract, are you supposed to charge taxes as you're going along, or do you charge them at the very end? You should charge taxes anytime that you are sending a bill to a client and there is a material charge on it. You should be charging and collecting and remitting taxes on those payments. Some contractors will wait until the very end to do it, and I realize they're doing that, but the safe thing to do is to do it up front and remit it up front. If you are a home builder operating under a separated contract, every time you buy materials, you give your vendor a resale certificate, and you don't pay that vendor tax. And then when you bill your customer for those materials for that marked up amount, you charge them tax, and then come the 20th day of the following month when you're filing your sales tax report, you turn those taxes over to the comptroller. But I'm going to stop you because I want to get through this, and then I'll talk to you afterwards, okay? Okay, but let me get through this. I think I'm going to have time, but let me get through what I need. Okay, so you've got, so if you don't have this, it's a lump sum contract. Okay, one thing that's important for you guys, This is the service rule that can potentially apply to you. It is what we call the real property service rule, and it applies to the recurring type services we typically see property management companies doing. It applies to garbage collection, landscaping, maintenance, cleaning, pest control, and surveying, but here it's only surveying to determine legal boundaries, easements, and things of that nature. Maybe 2 decades ago, the comptroller auditors were taxing the dirt work contractors and the contractors doing the various cleans, that occurred after the construction phases. Under this provision, the legislature got wind of it and wrote an exception into the statute that says for new home builders, that is residential construction, that for these services, not for landscaping that involves planting grass, planting trees, things of that nature, but for things that occur typically during the construction phase, the dirt work services or the various cleans, things of that nature, they are excluded from the sales tax from this particular rule. But you've got to have, and if you're one of these contractors doing it, you've got to have some kind of paperwork from the home builder that establishes the exclusion. This is a document, a certificate that our law firm worked out on behalf of many of our landscaper type clients and dirt work type clients. Anybody needs a copy of it, I can send it to you. That will satisfy the comptroller's paperwork requirements. They tell people to use exemption certificates. I don't like the use of exemption certificates because it's not an exemption. Exemptions are much, much harder to prove. Okay, let me talk about this now for neighborhood infrastructures. Oftentimes, you've got a real estate developer that's going to be developing the roads and the utilities, the various common areas of a neighborhood that will eventually be turned over to a city or to a county to maintain. Cities and counties are public institutions, so they're tax-exempt entities. Now, when you're constructing roads and utilities and these type of infrastructures, the labor is non-taxable. It doesn't matter that it's exempt. Labor is never taxable. The issue is the materials, and can you exempt the materials? And the answer is yes, you can exempt the materials, but you've got to be very, very careful in how you do it. What you've got to do is take your site plans to the city or to the county, have them review what you're going to do. They will give you what's called a conditional letter of acceptance. You have to have that before work begins. Then you, as the developer, install the infrastructure. The city and county will come out, they'll inspect it, make sure it conforms to the plans and to the agreement that you made, and then in the end, the infrastructure will be turned over to the governmental entity. And if you follow those rules, you can claim an exemption for the materials that are, and the supplies and so forth, the things that are going into that particular component. Be careful with gated communities. Oftentimes, cities and counties are reluctant to accept them in the end because if it's a gated community, it can be difficult for the police and the fire department to get into it. Plus, sort of in their minds, it's not really public property because you've got a gate there that prevents the public from accessing the property. So, gated communities can pose certain problems in this regard. Okay, for tax-exempt work, and this might be this might be road repair work in a neighborhood, doing exempt type work. Note that the exemption extends to the materials and to the consumable items and to services that would otherwise be taxable that are required under the contract and that are integral to the performance of a contract. So If you're a general contractor with a contract to repair roads that might otherwise be fully taxable, the exemption extends all the way down. Moreover, if you are a subcontractor working for a general contractor, the tax exemption extends to you, the subcontractor, as well. And it doesn't matter the type of contract that you have with a general contractor. It doesn't matter whether it's lump sum or whether it's separated or not. It will extend down. Yes, ma'am. So the question is, if you are a plumber or an electrician doing work on a commercial job, well, this is tax exempt. I'm not talking about commercial work right now. So let me do this. Let me talk to you about, if you have questions about commercial work, let me talk to you about that afterwards, because I want to make sure I get through this. And I think I will have time, and I'll be here for that. Are you okay with that? Because I'm really here for residential. So just keep in mind that when you're doing this type of governmental type work, if it's roads, highways, and neighborhood roads and such, the exemption extends to the contractor and the subcontractor, applies to incorporated materials, items that are consumed, maybe not necessarily transferred, and to services. Don't forget, there is, for diesel-powered equipment used out at a site, there is an add-on sales tax for items that are purchased or rented equipment. And it's called the TERP, stands for Texas Emissions Reductions Plan Tax. That is got to be added on. There's a lot of fights about this, and we see this surfacing in an audit. Okay, let me talk briefly about diesel fuel that might be consumed by you with equipment at a site. Here it may be, generators for lightings, forklifts, things of that nature. Diesel's 20 cents per gallon. Diesel used on a highway is taxable. Diesel used off-road is non-taxable. There are 3 ways you get diesel non-taxable or exempt. One is if it's directly dispensed into off-road equipment. You pull up to a terminal that dispenses diesel, dyed diesel, that is exempt diesel. You've got a flatbed with a forklift on it. They can dispense dyed diesel directly into off-road equipment. That's the simplest, easiest way. The second one is what I want you to know about. You can be, and this is a mouthful, an end user signed statement holder. If you are an end user signed statement holder, you get an end user number, okay? And you can purchase up to 10,000 gallons per month of diesel tax-free. That's a $2,000 per month savings. And what you do is you go to the comptroller's office and you fill out these applications. You tell them you're a contractor, you're going to be using the diesel in off-road equipment. So you fill this out. They give you this statement and you get a unique number. And then you take this statement with you and you either call your supplier who comes out to your site to fill your fuel tanks, and then he registers how much diesel you bought and what your number is, or you go to them and you fill up and you give them your certificate and your number, and he fills you up. And then you can use this diesel at your site, obviously only for off-road use, and you can save your money that way. At the end, what happens at the end of the month, all of these suppliers, they report on your number to the comptroller's office to make sure you didn't buy more than 10,000 gallons. And then the final way, this is the complicated way. If you're consuming a lot of diesel, then you'd be a dyed diesel bonded license holder, and there's a big application process, and you've got to maintain this distribution log, but that's beyond the scope of what you guys would probably ever use. But that end user statement is critical for you. Okay, now left time. I've got time. So anybody has questions, if you want to come up, I'll repeat your questions and answer any questions anybody has if I know the answers. Yes, ma'am.
Do you have a contract with a separated tax thing that we can follow?
Okay, the question is, do I have a contract that has the language that would be sufficient for a separated contract? Well, we're trial lawyers. We don't. I can point you to lawyers that have those contracts.
So that's my question. Instead of using a promulgated form, I would need my lawyer to draft this up.
Well, I mean, I think you can use a promulgated form. You just have to state a separate charge for the materials and the labor. That's all that's required to make it separated.
And to make sense, you really need to be collecting those taxes as you go.
Yes.
Because if you hand them a $40,000 bill, you're going to be screwed.
Well, you know, if it's a separated contract, when the bills go to them, you know, you ought to be separating your invoices ought to be separating your material charge from your labor charge and collecting tax on the material.